buy now, pay later. It kind of feels like magic at the checkout, doesn't it? But, well, it's not. It's actually a super complex financial engine. So today, we're going to pop the hood and see exactly how it works, who's really driving, and maybe most importantly, who ends up paying for the gas. Okay, let's dive right in.
I mean, we've all been there, right? You're shopping online and you see that tempting Pay in 4 button. It's basically become a standard part of the checkout process. But have you ever stopped to think about what's actually happening behind the scenes when you click it? Let's find out. So at its heart, Buy Now, Pay Later, or BNPL for short, is pretty simple. It's a form of short-term financing that lets you get what you want right now and pay for it over time. But the real hook, the thing that gets everyone excited, it's that promise of interest-free credit. You get all the instant gratification without that immediate hit to your bank account. So why has this thing just exploded in popularity lately? Well, it's really a perfect storm of a few key things. First, shoppers like us are actively looking for alternatives to traditional credit cards. Second, the world has gone digital first, with mobile payments and all that. And third, you've got these savvy FinTech innovators who saw a huge opportunity to shake up the old way of doing things.
Okay, so here's our game plan. We're going to look at the different ways BNPL works, then we'll meet all the key players in the ecosystem, we'll see it from the shopper's side and then from the business perspective. And finally, we'll try to answer the big question, who's really on the hook when things go sideways?
All right, first things first, let's get into the different flavors of Buy Now, Pay Later, because it's definitely not a one-size-fits-all kind of deal. There are a few key ways this can be set up. The one you probably see most often is pay by installments. That's where you split the cost of that new phone into, say, 4 easy interest-free payments. Pay later is even simpler. You get your order now and you just pay the whole thing off in 30 days. And then for those really big purchases like a couch or something, there's pay on finance, which spreads the cost out over a much longer time, sometimes with a bit of interest tacked on.
Okay, so now that we know the how, it's time to get to the who. And this is important because BNPL isn't just a button on a website. It's this living, breathing ecosystem with a whole cast of characters, and every single one of them has their own motivations.
Right at the center of it all, you've got the BNPL platform. That's the tech company pulling all the strings. They're the bridge connecting you, the user, to the merchant you're buying from. And then, sort of circling them, you've got the big established players, the traditional banks and the major card companies. And believe me, they are all trying to get a piece of this action. So let's kick things off with the player we all know the best, us, the shopper. For us, what are the real benefits here? And what are some of the hidden risks we might not be thinking about? I mean, for us as shoppers, the appeal is it's undeniable. It's just so convenient, often just a single click. It gives you a ton of flexibility to manage your cash flow without feeling that huge upfront financial hit. And honestly, it's a total game changer for people who might not have a credit card or don't have a long credit history. But, and this is a big but, that convenience definitely comes with a warning label. It's almost too easy to rack up debt. If you miss a payment, that interest-free deal can get very expensive very fast with late fees and high interest rates. And yeah, those missed payments can seriously damage your credit score. Plus, some of these platforms can be surprisingly restrictive with their limits. Okay, let's flip the coin and look at the business side of this whole equation. Why are merchants and these fintech platforms so incredibly eager to get you to split your payments? This quote from Visa just hits the nail on the head. Merchants absolutely love BNPL because it solves one of their biggest problems, what they call checkout hesitation. It just makes it so much easier for customers to say yes and click that buy button.
And the results for businesses? They're huge. They see an immediate jump in sales, and people tend to spend more per order when they can spread out the cost. It's also a really powerful tool for bringing in new customers. Heck, it even works as a marketing channel. On top of all that, the merchant gets paid in full right away, which is a massive win for their cash flow and it slashes their risk.
Which brings us to the true engine of this entire system, the BNPL platform itself. We're talking about companies like Klarna, Afterpay, or Affirm. At the end of the day, they are lenders that use slick technology to make instant credit decisions and manage the whole payment process for everyone. So how do these platforms actually make their money? Well, it's a pretty clever model. Their main source of income is a fee that they charge the merchant on every single transaction. But they also make money from users through things like late fees or interest on those longer-term plans. And they're constantly building out other ways to make money, like network and service fees, to create a really solid business. Now, the traditional players, they're not just sitting on the sidelines watching this happen. Oh no, banks are jumping into the game, using their deep expertise in credit risk and providing the financial plumbing to make it all work. And card networks like Visa and MasterCard, they're weaving BNPL right into their existing systems to make transactions faster, shoulder some of the financial burden, and help the whole thing go global. And that leads us to what is maybe the most critical question in this entire system. We've been talking a lot about interest-free credit and reduced risk for merchants, but that money has to come from somewhere, right? And that risk, it doesn't just disappear into thin air.
Okay, let's actually follow the money for a second. In the most common setup, the platform-funded model, the BNPL company itself is the one who takes the hit if you don't pay. They pay the merchant upfront, and they take on all that risk. In other cases, a really big retailer might just finance it themselves to save on fees. And what we're seeing more and more is banks or card companies stepping in to provide the cash and absorb that risk instead.
So the bottom line here is really, really simple. There's no such thing as a free lunch. The risk that someone isn't going to pay their bill, it never vanishes. It just gets passed around between the platform, the merchant, and the bank, almost like a game of financial hot potato.
So what are the big takeaways from all this? First, and most importantly, BNPL is not just a product, it's a complex system where everyone is giving and getting something. Second, while the benefits are pretty clear, the risk is always moving around between the different players. And finally, the real currency here isn't just money, it's data. These platforms are using enormous amounts of our shopping data to make split-second decisions, and that is their ultimate secret weapon.
And all of that brings us to the biggest question hanging over this entire industry. The whole model is built on this foundation of cheap, interest-free credit. But we're living in a world now where interest rates are on the rise, and that money isn't so cheap anymore. So, who's going to absorb that cost? Is it going to be us, the shoppers? Is it the merchants? Or the platforms themselves? The answer to that question is going to define the future of how we buy, well, pretty much everything.